South Korea banning crypto, Warren Buffett has his say, and what's the situation with the US dollar and how much further can oil go? Joining us to discuss the biggest talking points from the week is Jose Ricaurte Jaén. Well, Jose, thank you as always for joining us. Let's start off in the crypto markets. It's been a bad few days for the crypto markets. First, Warren Buffett gave his opinion and it wasn't too positive. Then news that South Korea may be ready to ban cryptocurrencies. How would you assess this week in terms of crypto?
Yes, absolutely, Jack. Thank you for the invite as usual. Well, so you have all these kind of players in the market that they're always giving out their opinion. Everyone seems to be these days entitled to an opinion. Now, what we have to face, what exactly is Warren saying? He's not referring to the blockchain technology, the whole engine behind cryptocurrencies. What he's calling is the excess of assets, if we want to call it now assets, is the excess of having XYZ amount of ICOs every week. It's like a parade of ICOs, and constantly you have to think like, okay, so I have 1, 2, 3 a week. Next week I have 10. It's not growing in a linear way, it's growing exponentially. So the audience have to keep in mind what exactly are these opinions referring to. His opinion is more into the excess of cryptocurrencies, and with that said, we have to admit there is too much right now of crypto, and in a lot of the cases there's no compliance behind it. Now, it doesn't mean that cryptocurrencies they have to be regulated as traditional assets. We're talking about equities, bonds, but they do in fact require some watchdog that is protecting the consumers, in this case investors, traders, if you want to put it that way, being the product crypto, and then the ones that are going to consume that product, investors and traders. Now, when it comes to South Korea, what you're looking here is the fact that countries are understanding now they're more aware of what's happening, and they know they're losing control of the game. I don't know how much you know about how Asia works a little bit, but most of these countries, they have a big eye onto the whole thing of make sure how the money is spent. There's a lot of control, how the government controls their citizens. So this might not be the case, but absolutely the fact is that they understand what's happening. They want to sort of have more control of it and make sure, in a way, people pay their taxes. Also, it's always a game, because right now what you have to see is that the status quo is challenged, and they are not going to let it go just like that. And I'm talking about central banks, I'm talking about brokers, big investment firms that they might see or not, some clients deviating from traditional products and looking into cryptocurrencies. So I don't think we have to sort of overreact to these opinions. Again, it seems everyone is entitled to one, but we need to go back and look at the facts. Bitcoin may drop back to 50% from, it can go back to 10,000, it can go all the way back to 5,000, and as long as the technology is in place, the value will remain.
Moving on, plenty of news out of China that could affect the slight US dollar rally that we saw earlier this week. What do you expect to see next from the greenback?
Yeah, absolutely. Now, when it comes to China, we have to always pay attention to what's happening. And as a suggestion, if the audience is interested in following this case, I suggest look for Howard Frein, CMT. He lives in Switzerland, and he wrote back in, if I'm not mistaken, 2017, a very important paper. It was an Elliott wave analysis on the dollar index, DXY, and he was calling for the end of the bull market in the dollar index. And if we take a look at the chart I have right now, very important levels to take a look. First, you want to take a look at the current level. We're coming back in this sort of small pullback here, allowing a lot of traders and institutions to keep shorting their dollars. Now, a close and open below the 91 level, which is a very important, crucial psychological level for the US dollar, will signal that not only the bleeding will continue, but the fact that there are tough days ahead for the US dollar. Now, this is very important because the next level to consider will be the 87, which is almost the beginning. If you look all the way back to July to November 2014 to the left of the weekly chart, you will see that this is a very important accumulation. Congestion and accumulation started for the last leg all the way back to the 100 level. Now, what we have to consider is that how this is going to reflect. It's true, this is not a secret that US treasuries are not attractive as it used to be for China. They are slowing down in their economic growth, and they need to look for assets that will actually give them some real juice for the money, and that's no longer US treasuries. Of course, also you have to keep in mind that the bond king, Bill Gross, mentioned that was the end of almost a 40-year bull market for bonds, sort of 40-year bull market for bonds. And as yields go up, and there's something that you have to keep in mind. This week we have sort of appreciation of the 10-year US yield, the 10-year treasury, and that did not translate into an appreciation, for example, of the dollar against the Japanese yen. That is signaling, sending that signal to investors that, hey, pay attention, there is some disruption in the market, and the dollars are not attractive as they used to be. What we should expect based also on, not only on Bill Gross comments, also based on the Elliott Webb analysis that Howard Friend did back in 2017, is the fact that if last year was bad, you have to tie your seat belts, because this ain't over. We're looking for another 10 to probably 18% correction to the downside for the US dollar.
And finally, Jose, oil prices have continued to rise at levels we haven't seen since 2014. Can this upward trend continue?
Yeah, it's interesting. Here's the rationality of the markets, how people, and I'm talking about retail sector. Okay, so we experience an increase in oil, prices are going up, everyone's happy. OPEC or no OPEC deal, things are working out just fine. But the most important is, if I take a Fibonacci, looking into technicals, right? So I take this, I can take it from all the way back to January 2011 highs, or I can take it from this. I'm going to take it just from this section to give you an example of what's going on here. And you think at 63 is expensive, it can keep going up a lot higher. And the target, if things are all in place, all the factors are in place, we're looking at the 61.8% Fibonacci, which is going to be a tough cookie to crack. And we'll see that at 76, it will be something where I will think at that level there's a really hyper extension of the price, and then we'll need a massive correction. Now, of course, it won't go there in straight line. I do not rule out, and I will need this to go back to 58, maybe below this 58 range, and then make this move. And after that, I will look to a move higher. Now, remember, as inflation knocks our door, then these assets, energy assets, will be very attractive, and you will be looking at hedge funds to place more long bets into oil all the way to 2019, 2020.
Well, Jose, thank you as always. You're an absolute superstar.
Thanks to you, Jack. Thanks for the invitation.
And thank you for watching. And if you like this interview and would like to find out more, as well as watch more brilliant interviews with Jose, head over to dukascopy.tv.